So overall, other income growth, where we have also seen a significant growth or income coming from exchange revaluation. So not as much as, of course, some of our competitors, but we have done fairly well there. But the biggest negative for 2018 was the increase in impairment. So I'll touch on impairment specifically as I go on with my presentation, but it suffices to say at this point that it went up by almost 150% to 9.8 billion. Operating expenses were managed fairly well, only a 12% increase, given that 2018 was a year of collective agreement where the salaries of all the clerical staff or non-executive grade staff was increased, which happens once in every 3 years. Then PBT, we witnessed at a group level a 15% increase. PAT, a 14% increase to 19.1, and profit attributable to shareholders, 11% at 17.6 billion. So this is the bank numbers. Again, it more or less reflects what the group has done, a 20% growth in NII. Fees and fee growth has been 13%. Other income, 118% growth. Impairment gone up by 200%. And overall profit before tax growth of 4%. Income tax VAT went up significantly. And as a result, there was a 6% drop in PAT, though profit before tax grew by 4%. So this shows how profits have moved from 2017 to 2018. So you see a significant or the biggest contribution to growth in PAT for 2018 came from NII and then from other income, where a significant part of that was from exchange gains. But then you see the significant negative was provisions, which increased by over 5 billion. And then, of course, you have the expenses and the taxes eaten into the rest. So overall, what you see is the growth in profit attributable to shareholders by 11%, despite the increase in provisions and taxes. So this is at a bank level. So you see the reduction in, again, the PAT at a bank level. The positive contributions came from NII and other income, but provisions and the increase in taxes have eaten into the increase. So going into ROA and ROEs and how the composition of ROAs and ROEs. First, looking at ROA at a group level, which has grown by about 3 bips. Main contributions came from NII. The margins improved from what we saw in 2017. So NII to average assets went up to 4.92 from 4.76. Other income as a percentage of average assets have grown from 166 to over 2%. The impairment, which was at 40 bips in 2017, went up to 90 bips, more than doubled in 2018. And then operating cost also improved from 3.02, went down to 3% as a percentage of average assets, and taxes, of course, went up to 1.31. So overall, at a group level, ROA marginally improved. But then the full impact of the rights issue that we did in 2017 also came into effect in 2018. And as a result, the leverage factor came down. And therefore, though the ROA improved from 2017, the ROE has slightly come down from 14.95 to 13.85. So at a bank level, you see the ROA also got affected. The NII as a percentage of average assets improved as margins improved. Other income also improved, but impairment significantly went up. Operating cost more or less remained the same. There was a significant increase in taxes. So ROA came down, and also the leverage factor reduced. So therefore, the ROE came down to 13.86. So NIMs have continued to remain strong. We have done fairly well in terms of our CASA drive. You will see that as a percentage of overall deposits, we have a CASA ratio of 35%. We have been able to defend it more or less at those levels. I think 2017, it ended up at around 36%. So there wasn't a significant drop in our CASA ratio like some other banks have witnessed during 2018. And also the interest rates remaining high helped us to maintain our margins at the levels that we have seen. So at a group level, margins improved from 5.4% in 17 to about 5.6% in 2018. And at a bank level, it has gone up from 4.9 to about 5.2%. So the portfolio mix, you see corporate at 45%, you see mid-market at 4%, SME at 30%, and retail banking at 21%. So fee income growth, we would have liked to have done slightly better in 2018, but overall there was a 13% growth in fee income. The drawback in fee income was we didn't see too much of guarantee fees coming in as a result of probably projects getting stalled or not seeing too many projects taking off. But credit cards have done fairly well, and that remains our largest contributor to fee income. And also trade and remittances did fairly well last year, as you would know that the imports were fairly robust. But if you look at the 5 years on a CAGR, we have done around 18% or almost 18% at the bank level and almost 19% at a group level in terms of growth in fees. So if you look at contributions coming from segments to total operating income, we see corporate banking doing around 27%, retail at 35%, SME at 35%, and micro at around 3%. So we have spoken a lot about cost to income ratio and improving efficiencies, driving efficiency gains. And as we speak, there's a 3-year project that we are working on in changing organization structures, in changing branch operation models in order to ensure that we increase our headcount mix where majority of the people will be serving customers and bringing business compared to the back office staff which will be doing operations. So with those changes that we have done over the years, the centralizations, the changes that has already taken place, we have seen cost to income ratio improving significantly. So if you look at the bank, cost to income ratio has dropped to 36% compared to 39% in 2017, and even at a group level, it's come down to 43%. And the reason why there is a gap between the bank and the group is because the claims that HMB Assurance has to make also comes as part of an expense there, as an expense line. So that's the reason why there is a 5% gap. But you see the trend is it's coming down, and it's a significant drop. And we probably are among have probably the lowest cost to income ratio in the industry. So this is where I think the main topic for the day, the increase in provisions. You see NPAs went up. I think the industry has seen NPAs going up, and IMPA has remained below the industry. So increase in NPA, increase in provision was contributed by the increase in NPA, but in addition to that, the introduction of IFRS 9 also resulted in increase in provision. So out of the total provision that was made, around 38% came because of the new standard being introduced. So some of the things that are being done in terms of managing NPAs, in terms of improving impairment is what we have mentioned here. We have appointed a chief credit officer, a separate vertical, independent of the business, who looks at all retail and SME loan approvals. So there is a complete segregation between business targets and approving facilities. And we have also having a centralized collection unit, which we introduced in 2017, and we see certain positive impacts coming from that. Going into shareholder returns, I think I already spoke about ROEs, ROAs, and we see there's been a steady growth in our PAT for the group and also for the bank, with probably the exception of 2018, where our PAT was slightly lower than that we managed in 2017. So loan growth has been comparable to the industry or slightly better at 18%. Deposit growth was at 14%, and we probably had one of the best CASA growth compared to the industry at 11%, given the size of our CASA portfolio. So capitalization, we believe we are quite confident with our Tier 1 capital base. I think the requirement is at 10%, and we are close to 13% at 12.8%. When we went into our rights issue in 2017 and raised almost 15 billion, we did that with a projection of for the next 5 years, so up to around 2021. So at that point, why we went for such a large capital raise was that we realized that we needed that to sustain us for the next 5 years. So with that coming in, we feel we are very comfortable with our Tier 1 capital position. But of course, Tier 2 will need to be supplemented, because there will be debentures that will be maturing, and as the Tier 2 or total capital adequacy ratio is going up, we might have to keep on coming to the market in terms of Tier 2 capital raising by way of debentures. So this is a slide just to show risk against profitability for HNB. One table shows ROE against Tier 1 ratio. So you will see that HNB is at a fairly strong position compared to some of our peers in terms of ROE against Tier 1 ratio, as well as ROA against NPAs. So risk return profile seems to be quite good. So shareholder returns, unfortunately, there's not much to talk about in terms of the share price movements, because the share market has not been doing well, but we continue to give a total dividend per share of 850, where 350 came by way of scrip and 5 rupees came by way of cash. So these are some of the awards we won during the year. I think there's a whole list of awards that we have won, and there's a lot of recognition that we have got for the achievements that we have made over the last couple of years. So with that, I would like to end my presentation, and I'd like to open the floor for questions. And I would like to invite Mr. Jonathan Alas, Mr. Dilshan Rodrigo, Ms. Tushari Ranavira, and Mrs. Anusha Gallage to join me at the head table. Thank you.